This is Ben Peroisich with Remax, and welcome to your real estate market in a minute. Well, today I wanted to answer the question, should you buy now or wait for real estate mortgage rates to come down? And actually, I did a video on this earlier, but I think it's timely to do it again. I won't keep you in suspense. This is a little bit of a trick question now because mortgage rates aren't coming down. We all thought they would come down. I did. You probably did. Analysts did. Policymakers thought they'd come down, but they're not coming down. In fact, mortgage rates are going up. They're 6.42% today. 3 months ago, they were 5.8%, so they're up 0.6%. What gives? The Fed had lowered rates. Mortgage rates keep going up. What's going on? Well, the short answer is one word: inflation. Inflation seems to be coming back. The CPI, which is the Consumer Price Index, it's a number that's supposed to encapsulate what we as consumers pay for goods. That is up to 3.8%. That's up 0.6% from a month ago. And that's a significant increase. And as inflation goes up, bond market participants make interest rates go up to try to dampen the inflation. The Fed kind of doesn't even have to act. The market sort of does it on its own. And it's really important to try to distinguish whether this is like a spike in inflation, like it's transitory. Remember that word from after COVID, when inflation really started to get out of control and the Fed thought it was transitory, temporary, and they didn't raise rates right away. So we have to try to figure out, is this like just a spike, an episode, or could this be a trend? And there's one clue that I know of. It's called the Producer Price Index, PPI. And that is what manufacturers pay for their raw materials before they convert the raw materials into products for us to buy. And PPI is unbelievable. It's 6.1%. It's up 1.4% in the March to April period. And it's up 3.4%, almost doubled since February. That is really, really seriously bad if you read up on it. And the reason it's bad is because these producer prices lead our consumer prices, which makes sense because a factory will buy their materials, and if their materials go up in price, they will try to pass those increases along to us. So this suggests that the CPI that we pay is going to continue to go up in the months to come. It's not a guarantee, but it's kind of reading in between the lines. It kind of suggests that our prices will continue to go up. And then that doesn't really give much room for mortgage rates to come down, and it doesn't give much room for the Fed to lower rates. Kind of my last point on this is there's a really interesting tool. You've probably heard of it. It's called the Fed CME Watch Tool. And this kind of is a probabilistic predictor of what the Federal Reserve is going to do. And it's based on what market participants, really sophisticated traders, are doing in the futures market. And currently, the Fed CME Watch Tool is saying there is a 0% chance of an interest rate decrease for the rest of this year, a 0% chance. Now, is that a guarantee? Actually, it's not. This tool can be wrong. But it's usually not. So we've got a lot of things pointing in the direction of no rate decreases for this year. And in fact, a chance that if inflation continues higher, that the rates and mortgage rates will also continue higher. So what is the advice if you're a buyer? The advice is to buy now before rates go up more, which is a definite possibility. If you can afford the 6.42% rate, you should take advantage of that rate now. Um, and then you'll be insulated from further rate increases should they happen. So it's not really good news, but that's the way it is. And that's your real estate market in a minute. If you like to learn something, go ahead and like, share, and subscribe. Thanks so much.